So our last segment will be led by Matt Petroski, who is a partner at Armanino, a national accounting and business consulting firm. He comes to us with 25 years of experience in the industry and will be leading a discussion on charitable tax strategies for you as you consider planning for your exit. So, Matt, welcome.
Great. Thanks, Margita. Great to be here. This is sort of the don't forget about this part segment as you're getting to the end and you're looking for that transaction. So by way of background, as Margita said, I've been 25 years in the industry. Before Armanino, I was with PwC for about 18 years. I've worked with some of the largest nonprofits in the country, startups, everything in between. One of the aspects of what I work with is also some of my partners with their high net worth clients, business owners, and a lot of their charitable giving. So it's that piece of one of the questions was asked was, well, what do I want to do? Where do I want to lead? What are the things I want to do with my life? And for a lot of people, it leads to charity, where they'd like to leave their mark. And so then the next question is, okay, how do we do that? When should we be thinking about that? And as you're getting to a business exit, that's the perfect time. It's a liquidity event. And with liquidity comes a significant amount of gain. So it's important to look at possible options, things you can do. If you're able to plan in advance and you're able to kind of avoid one of the things, so obviously the two main tax parts of charitable giving is, do I get a deduction and can I avoid any tax? So appreciated property is one of the best things you can donate. So if you think about it, these business owners, they have there's property that's appreciated. It's the stock in your company. And so planning ahead before the LOI is to be able to make those contributions. You can have a significant impact where you're able to contribute at that fair market value and not ever having to pay the tax on that gain. So I think that's something that a lot of business owners need to be thinking about. And then a lot of it comes to the different types of vehicles. So there's a number of different ways that we can give. I know a lot of people that might give directly to a charity. Here, maybe we start thinking bigger. If you don't have a donor-advised fund, start thinking about the donor-advised fund space. When I talk about the tax bill, I'll mention why I'm seeing a little bit more of that now. Maybe you want to start a private foundation. Maybe you have a private foundation, and I see a lot of private foundations where they prepare for that liquidity event, where the business will be sold and significant amount of assets will be put in there. Then kind of that question is, if you're starting up a private foundation, is that what you want to do? It's running a business. It's running a business of a charity. You're doing all the investment planning, because that's essentially a lot of larger private foundations. They're just like endowments. So you're running an endowment, but you're also grant making and maybe also planning in other aspects. The private foundations have a lot of strict rules, and usually I say because someone somewhere along the lines did something wrong. You can't pay for your kid's wedding out of a private foundation. Things are pretty clear to a lot of us. Not everyone who owns a private foundation necessarily thinks that way. So maybe is that the right vehicle? For some individuals, they're thinking long term in that the charitable planning perspective. So do they want to set up a charitable remainder trust where they're going to get the deduction now and eventually the remainder will go to that charity because maybe somebody needs the income during their lifetime. It could be a charitable lead trust. It's a big asset. You want it out of the estate. So it will pass to your heirs out of the trust. So it'll stay out of your estate, but then the charity's getting the income during your lifetime. So there's a lot of different things to consider, but especially planning around a stock event, you need to make sure you have a valuation and think about it ahead of time. And the type of vehicle. So I think kind of starting early, a lot of it gets to what do we want? What do we want? What do I want to do? And so that might lead to the vehicle, and it could be multiple vehicles. Could have I work with a lot of high net worth individuals who have they'll have charitable trust. They'll have they'll have donor advice funds. They'll have foundations, and they all do different things. And so I think for business owners who are going on to that next step and think that that's an area where they'd like to get into, I think there's a lot they can do. Or it's something as simple as, I just like to increase my charitable giving. So I think that's something to consider. And if that's the case, any appreciated assets are really the type of thing that you'd like to contribute. As I kind of mentioned a little bit about the Tax Act, the one big beautiful bill that recently passed, charitable giving 2026 going forward is a little bit different. There is a 0.5% floor on donations. So basically that first 0.5% of individual donations relative to their AGI is non-deductible. So if it's something big, I mean, in the smaller stage, it could be minimal. AGI that's a little bit smaller, you may not notice it. But if, let's say, you want to make a $50 million donation, that AGI is $250,000. So the first $250,000 of your gift doesn't count for tax purposes. So what we're seeing a lot of is bunching of gifts. So really kind of thinking about modeling out how would I like my charitable planning to go from a tax perspective. Does it make sense for it all to be in 1 year? And if so, do I give it to the foundation? Do I give it to that public charity that I support directly? Or what we're seeing is a lot of donor advice funds coming into play and being more popular, because you still have a little bit of that control of making sure you're not giving the charity too much money all in one particular year, but you're only having that hit from that floor once. And then you can still distribute out of your donor advice funds over a period of years. So I think that's something to consider. The other thing is there is a cap. So at the top tax bracket, the deductions are limited to the 35% bracket. So for anyone in the 37% tax bracket, they won't get the full benefit on the top end either. So I think these are things that I think we had a lot of conversations with people about accelerating 2025 contributions before these came into play. So I think that's, obviously it's a little late for that now, but I think now that we're living in this world, it's do we start bunching? Do we start using our donor advice funds? If we create a private foundation, and I have a lot of conversations with people about, at a certain level, how not to do it and why not to do it. You can pay your children to run the foundation, but that is a retirement plan, is not a great strategy. I've definitely heard that of someone wanting to sell their business and, hey, I can pay myself, so I'll just start a foundation. But remember, you can pay reasonable compensation, but there's other things that you just can't do as a founder of a foundation. So I think those are really, just from the perspective of think now, what are my charitable goals? There are a lot of different vehicles to consider and a lot of different ways to do the giving, but there may be better ways of doing it from a tax advantage perspective, and even just from a stress or cost. Maybe the vehicle that's chosen might be more expensive, but that might be the appropriate vehicle given the donor's expectations. I did include I think everybody at the table, it's a basic, really basic breakout of what giving appreciated assets would be. So if you're selling that business and making that contribution, what would happen if you were giving cash after the fact? What if you were giving the appreciated assets after, if you weren't giving anything? So I think what that shows is a little bit of the benefit of how you can impact your tax position after. I didn't bother including any of the tax acts, so I didn't want to complicate it by adding in the 0.5% floor. But I think they still do apply, and it is basic. And the one thing you know is normally the situation is more complicated, and very often modeling out what it would look like and what the best strategy would be is the best way to go.